Hi there, I'm Jerry Nelson. I'm here to work with you today going through the business management for new contractors, and I know that this can be a problem. People are worried about this part, being a business manager while you are doing your contracting. Not a huge big problem when we get into learning a couple of things. Nobody's going to be asking you to figure out with calculators and hammer a bunch of numbers around or cut off certain profits. We're not doing that stuff. We're just figuring out how to read certain profit and loss statement, balance sheet, how to know where things are at so that you as a new contractor can manage your business. Now, I have been formally licensed as a specialty contractor. I've worked as an estimator. I've worked as a project manager for a general construction company. I presently manage a condominium association, construction projects, and I've also been a bookkeeping and a consultant for small business. So I understand the difficulty with how to approach this stuff, and it's not going to be a problem. We're just going to go through the chapter here. So right away, I'm talking about page 2, the scope of management. As a general contractor, you're a new general contractor, you are even an existing contractor that's finally getting licensed, all of these things, we have to think about what the management of the company is. A manager has to plan the major activities of the company. You have to coordinate workers, subcontractors, and get the project done. You have to train your staff and train your employees. And as the boss, you have to direct all activities to accomplish a goal. Keeping your focus on earning a profit. It's not such a good thing as a contractor or any business to work just for fun, because in the end, you got to earn a profit to be able to stay in business and go on. You want to keep track of your competitive advantage. You want to make sure that something like what your business does is a little bit better or a little bit different than another company. Your executive abilities, your executives, your owners, yourself. Everybody needs training. We spoke earlier, you have to coordinate and train your staff and employees. Managers need to be trained too to get better. So I'm going to jump over here to page 5, and we'll talk about types of business organizations. Most small businesses, small business owners start out as sole proprietorships or sole ownership. You're the boss, everything happens, what you say, and that's pretty easy as a way to start a business. However, one of the drawbacks to being a sole proprietorship is unlimited personal liability. If you're building a stair and you build the stair and for some reason something happens and the stair falls down, breaks, somebody trips on it, when the lawyers get finished, it's you, the sole owner, that is standing there going, that was my work. I got to stand behind my work. Now everything I have is on the line. If you're not taking big projects, okay, that's fine. Sole ownership works good because, of course, like I said, it's easy to do. But a lot of businesses, after they've been a sole ownership for a while, they look to move somewhere to limit their liability. General partnership is another form of organization, like a sole ownership, pretty easy to do. You get together with another partner, maybe you know one part of the business, somebody else knows the other, you get together, you form a general partnership. Sign a few papers, you got a partnership, and you basically operate again like the sole ownership. Pretty easy to do. Drawbacks. You got to be able to get along with your partner or whoever else is involved with the partnership. You might have multiple partners, 2, 3, and it gets a little bit harder sometimes that everybody gets along and decides, yeah, this is the way we're going, this is what we're doing. Again, a drawback. We still have, even in a partnership, the unlimited personal liability. Easy business to form like the sole partnership or sole ownership, but the general partnership also has unlimited personal liability. There is a limited partnership down there, bottom of page 5. Also up at top of page 6, a limited liability corporation. Again, another form of business. I'm not going to go so much into all of the specifics of how the LLC is formed. Yes, it's another way to manage a construction company. I'm going to point out, though, that there are more requirements on an LLC or limited liability company. If you highlight down at the bottom, the last paragraph there, it says the Contractor State License Board requires LLCs to post a hefty bond. It has the amounts in there and a couple of the other things that you'll have to do as an LLC. Again, this is just one of your options when you're having a company that you would create the type of business it is. The next one we'll hit, probably more important, is a corporation. Down at the bottom of page 6, it talks about a corporation is an entity that's formed. It's a legal entity that's formed by the government, is recognized by the government as the one who is conducting the business, and the legal entity needs to have employees, such as you, the real owner, who might be the shareholder, the major shareholder for the corporation. You still could have a corporation that only has 1 or 2, 3 people in it, and it might have a sole owner from a previous sole proprietorship, and now you're doing business as a corporation. The good thing about a corporation is that it shields the owner, the shareholders, from unlimited liability. We talked about this earlier with the other forms of business, the proprietorship, the sole ownership, even the general partnership. Something happens, you're on the line. Total unlimited liability. However, when a corporation does that same stairway we were talking about before, the corporation has a lawsuit coming after Mr. Hammer Company or whatever it is that did the staircase. The corporation is the one that stands in front of it to represent to the law, to anybody looking for damages. It's just the corporation. The owners of the corporation, the shareholders of the corporation, are protected, limited to the amount of money that they have put into the corporation. Corporations are good. They solve a lot of problems. Many times when businesses start to get a little bit bigger, a number of more people working for them, they want to go to the form of a corporation. This is fine. One of the things that happens with corporations, though, is they take a little bit more work. We have more forms to fill out. We have more stringent requirements for contractor's license, for the Internal Revenue Service. We have issues that we have to deal with that require us to keep very strict documents. We can get away without doing that as much, being a proprietorship, sole proprietorship, general partnership. But when you get to the corporation, in order to get the benefits of being a corporation, you have to do the other things. One of the benefits for a small corporation deciding to incorporate is tax benefits. You can find that when you're a small businessman, suddenly everything that the business earns is your profit. Well, wait a minute here. If I want to make an investment in the business, in my own business, and buy more equipment, I want to make an expansion, I'm using my money, my profit, to put back into the business. Yeah, you have to pay tax on that because it's a profit. Whereas if you're a corporation, the tax code is set up to say, okay, we're going to tax the corporation's net profit, and the deductions for the salary for the owner, that's a deduction for the corporation, lowers the corporation's total income, and there's less taxes to pay. Sometimes it's a good idea to change from a sole proprietorship to a corporation when you realize that you have tax problems, when you realize that you might be running into liability problems. Some companies might decide that they want you to be a certain size in order to deal with them. A general contractor might not say, oh, you're a sole proprietorship, that's okay. They might say, gee, if you were a corporation, then you could do business with us a lot easier. I want you to know that if you're going to make a shift from being a sole ownership to a corporation, you're going to have to go find a lawyer, you're going to have to fill out articles of incorporation, have to get another license from the state board so that the corporation is licensed as well. And yeah, you're going to have to start doing some of these business management things. Sometimes this is a really good thing to do, good step to make in your evolution as a small business contractor, general contractor, specialty contractor, trying to grow your business larger. Okay, so we're moving on over to everybody's favorite subject, taxes, on page 9. Taxes, as a business owner, you're responsible for making sure that taxes get paid, just like you have to make sure that the business is operating well, all sorts of the areas of business are operating well. As a business owner, as a manager, you have to make sure the taxes are getting paid. Whether you're a sole proprietorship or a corporation, a limited liability company, there are taxes that you have to see that are getting paid if you have employees to the Internal Revenue. The IRS issues what they call an employer identification number. This is a number that is particular to your business. It might be particular to your corporation, and identifies any returns that you have to send to the IRS. The State Employment Development Department will issue a number. Okay, so we're going to go over to page 10 now and look at state sales and use tax, also district sales and use tax. These taxes are part of the taxes that go with the state sales tax. State sales tax is collected and paid to a state tax agency. And what happens is districts, the state is divided up into individual counties. The counties have most of the time their own tax rate. So when you pay sales tax, you go and buy a stick of lumber, a board of lumber, you pay tax on the board of lumber. You need to pay the tax. It's when you go to the store, you just pay the tax. But what they need to do is they need to take it down and go, oh, this much is for the state, this much is for Sacramento County, and this much is for the transit district. When they get broken down on the tax return, that you report these on, you will see the amounts that go to the various agencies. Again, not your job to understand to put those into various agencies, but I want you to realize that as an owner, as a business owner, you're responsible for paying attention to whether something is subject to state tax, whether it's subject to a use tax, whether the state district tax and use tax is being paid on it. Usually this means that at the end of the time period that you're preparing your reports, you have to work with your bookkeeper, your accountant, your tax preparer and say, oh yeah, that project we did was in Sacramento County. Oh, that project we did was down in Solano County. We need to know that how much is allowed for the taxes to that district versus the taxes to the other district. So again, as a business owner, as a general contractor or a specialty contractor, you're responsible. When you're managing the business, this is one of the areas you need to pay attention to. I'm going to jump over now to page 12 and talk about insurance. Every business has to have insurance. There's lots of different types of insurance, but we're just going to kind of skim over the top so that you're familiar with what's going on. Usually you have insurance. You buy insurance for a term of 1 year. Your insurance agent or insurance broker would set you up with a couple of different kinds of policies. The amount they charge you and how much they protect you are depending on the premium. The premium is the price you pay for the insurance for 1 year. It might be broken up into you have to pay every month, or you have to pay every 6 months, or once a year. Different things for different insurance companies. Just like you have a car, you have to have car insurance to drive your car. When you have a business, even if you're a sole proprietorship and it's just you and your tools and a couple of materials, you still have to have insurance to cover you as a business as opposed to driving your car around to the store or going to pick up groceries. I'm reading right down page 13 about the different kinds of insurance. One type is a commercial auto insurance. A commercial property insurance is another type of insurance. Commercial general liability insurance, workers' compensation insurance. All of these things cover different things. Again, commercial auto. If you use your truck for transporting materials to a job site, or you use your truck to have your employees drive to a job site, your regular homeowner's insurance doesn't cover that. Your regular car insurance doesn't cover that because it's being used in a business setting. So that's why you have to go and find a business insurance policy for commercial auto. Now, a commercial general liability policy is what you buy as a businessman to cover everything. Commercial general liability covers you, the work you're doing at your office, at your warehouse, at a job site, at 2 different job sites at the same time. All of those things are covered as a completed operations for your general liability insurance. If somebody's walking along the sidewalk outside a project that you're working on and a gust of wind blows a bunch of dust off the property onto somebody walking by on the sidewalk, they could turn around and sue you. Well, they can sue you and they might sue everybody else that's there. You need to have your commercial liability insurance to cover this. Again, it's a broad form of coverage and it's available to business owners for construction companies. You go to your insurance agent, your insurance broker, and they will get you a price for what you do, what type of business you have. They're going to want to know, you're a plumber? Okay. You're an electrician? Okay. You're a painter? Okay. Oh, you only do metal scaffold work on the outside of buildings? Okay. These are all very specific kinds of companies, and the insurance companies, the insurance agents will know we have a policy that will cover what you need. Everybody gets a policy and it's a limit. They have limits such as, like your car insurance, $100,000, $300,000, $1 million. All of these things describe the limit of what the insurance is good for. When you're operating your business, you want to make sure that you stay doing projects within your limits of insurance. Most of the time when you go do a project for a general contractor or another business, they're going to ask, okay, so you're going to do this job for us, you're going to repair this, you're going to build this. We want to see your certificate of liability insurance. We want you to give us a certificate from your insurance company, your commercial general liability, that says you got this much insurance. That's a real routine thing that happens when people start changing and signing contracts and getting ready to do a job, is they want the certificate of liability. Very important at that point that you have your coverage in place and that it's paid for. The term covers the term of the job you're going to do, because you may be all signed up to do a job, you have your contract, you got your tools, everything's all ready to go, and the company says, whoa, wait a minute, you don't have insurance. They won't even let you walk on the job site if you don't have insurance. So very important. Umbrella insurance is a policy that is a separate policy and covers over all of these types of policies, your auto policy, your commercial, general commercial policy. What it does is it's a second tier of insurance. Most insurance policies, as I said, will have a limit, such as $1 million. They'll cover claims from a deductible, of course, to $1 million. You're covered. Today, with big dollar amounts for claims and things that can happen, it's not unheard of that somebody can sue you for more than $1 million. If your insurance is only good to $1 million, that's it. That's all they insure. So when you have to pay the claim for $1,100,000, $1.2, $1.3 million, the rest is on you. You can, as a company, buy umbrella insurance. The way the umbrella insurance works is that company's policy says they don't pay anything under $1 million, but they'll pay everything from $1,001,000 to $2 million. What they do is they provide an umbrella over your other policy. An umbrella policy not required unless you need higher limits. If you need limits higher than your regular commercial insurance would afford, you would buy an umbrella policy. Again, know that these exist and you're working with your regular insurance agent to find this stuff out. So, we're going to go over to page 14. We're still talking insurance. We're going to talk about on the coverage of insurance, two different types of coverage. Insurances generally have a coverage that would be indicated on your certificate of insurance as occurrence or a claims-made coverage. Most of the time, your insurance would be of the occurrence type. Basically, it says that if a claim is filed against you as the owner, and it happened while you were doing your business and you were properly at the job site doing your work, something happened, you're covered. Even if the claim is filed after the event happened, the insurance was in effect, you're covered. This is a occurrence coverage type. With the claims made, it's a little bit of a limited amount. What it does is for the insurance companies, they say, okay, we'll write this insurance, but the coverage is only going to be good while the policy's in effect. So if you have a policy that lasts 1 year and somebody turns around and says, oh, hey, this happened 2 months ago and I want to file a claim, if it's on a claims made basis, they're not going to accept it because it's past the date that the policy was covering it. So the claims made generally is not as good as coverage as the occurrence type. Once again, when you get your certificate of insurance that you're going to be able to give out to the potential job you're going to do, the owner will ask for your certificate of insurance. It'll say on there whether it's claims made type, occurrence type, and how much it covers. One of the big things that happen to general contractors, small contractors in business, is you get so busy working on your jobs, you forgot to pay the insurance premium. You forgot to renew it. Nobody's there telling you, oh, geez, the insurance is only good until July 1st. And then after that, you got to renew it. Yeah, you got a renewal notice in the mail. It's like, oh, yeah, it's in a month. I'll forget about it. When your insurance expires, it stops. They always tell you on your policy it stops at 12:01 a.m. It stops. You don't want to be in this situation. You must pay attention to when the policy's renewal dates are. It could be in the middle of a project where you have a project that goes from January to December, but your insurance renews in July. You have to make sure you get that renewed on time so that everybody who you are covering is covered from June 30th to July 1st, and you make sure that you get your premium paid so there's no interruption. Not a good thing. If your policy of insurance or certificate of insurance tells the company you're working for that it expired, they're going to have somebody come out to you and say, gee, you can't be on the job anymore. I'm right in the middle of something. No, you need to leave because your insurance is not in effect. This is very important stuff. Have to pay attention to. Okay, right now we're going to go over to page 16 and we're going to start talking about accounting. Now, accounting is very important for all businesses, not just general contractors, specialty contractors. Accounting is very important principle for business management. You cannot just say, oh, I'll get some bookkeeper to take care of the whole thing. You have to understand what goes into proper accounting methods. The basic concept here is record keeping. As a business owner, you have to make sure that consistent, regular bookkeeping is done. Keeping the records consistently in the same manner all the time. It doesn't matter whether you keep your receipts in a shoebox. It doesn't matter if you have a full-time bookkeeper that prepares reports to fill binders and binders of reports. It doesn't matter if you have somebody helping you do it every once in a while. It has to be consistent. Okay, we're going to pick this up and we're going to talk about these users that are going to take your information and need to look at your business, need to look at the size of it, need to look at how reliable it is. All of these can be figured out through the practice of accounting. That's the language that everybody uses to show your business financials. The Franchise Tax Board, any of the other taxing agencies have to be able to make sure you're complying with various requirements for expenditures, making your payroll correctly, paying your payroll taxes. If you want to borrow money, the banks want to know how your business is doing. They want to see it in a proper report, proper form. If the bank says, well, how's your business doing? You go, not so bad. We got these jobs going on. That doesn't work. The banks have to know, hey, are you making a profit? Well, I don't know. I haven't filed my taxes yet. We don't care. It's July. You need to know whether or not you're making a profit so far this year. Did you make a profit last year? Is it better or worse than last year? Without proper accounting and management techniques, you're not going to be able to answer these, or you're going to try to stay up all night to figure out how to do it. Not a good deal. So, by keeping good, consistent records, make sure you can run your business out of a checkbook. Doesn't matter as long as everything is written down, that you can answer questions to whoever is going to prepare your reports, your bookkeeper, your accountant, that you can say, yes, this is when I paid this check number, this amount, this was paying for that. Very important. When companies get bigger, such as corporations, sometimes corporations have to give reports internally, like to shareholders or to some of the business owners, so that, again, how the health of the business can be understood in numbers. Very important. On page 18, we're going to talk about types of accounting. This is kind of a simple division. Most all reports are prepared either using the cash method of accounting or the accrual method of accounting. Cash method versus accrual. It's always written on the report so that somebody knows whether they're looking at a report prepared by cash method or accrual. Basically, the difference between the two is cash method accounting says that when you receive income, whether you receive it in cash dollar bills or checks, deposit, put it in the bank, that's the moment that your business recognizes the income. The moment you take the money, put it into the bank, you've received it. That's income on a cash basis. That doesn't necessarily mean it's a small amount. People can have a cash basis of accounting for large amounts of money and through their business. It's not a problem. It's just that all the records have to be kept that way. An accrual basis is where you recognize the income when you send the bill or it is due to be paid. The cash versus accrual basis is a little hard to understand. hey, I'm not going to write them a bill and if they're not going to pay me. That's not the point. It's when the business recognizes the income and we can adjust the income with the expenses that were actually made. Keeping records for all of this is what the key is. We're going to talk about a couple of the different accounts that you would set up, a typical chart of accounts it's called, where you would have your business record all of its expenses and its income and its assets in different account titled. The records that need to be maintained, you have to maintain good quality records for a period of time. When you're filing taxes, they tell you they got a statute of limitations, or they tell you they need to have records for you to keep for 5 years, or you be able to produce these records for 7 years. This is all important. You can't just fill everything out, take that shoebox full of receipts and everything and throw it away. You got to be able to have the backup and the properly prepared reports to show to any entity, such as the taxing entities, that would need to see this. Okay, right now I'm going to jump over onto page 20. Going to talk about accounts receivable. We think of accounts receivable as you've written an invoice, you've given somebody a bill, you owe me this much money for the work that's already done. That's a bill, a billing. If we're in accrual method, that's a sale right there. If we're in the cash method, it's accounts receivable. We haven't received that yet. It's not the sale until we get the cash. Our accounts receivable is money that's due to us. We expect it to be paid within 30 days, 60 days, 90 days, 45 days. All of the accounts receivable are money that are owed to the business. When your business says to somebody like the bank, well, our business made $40,000 of sales last month, and we have accounts receivable this month of $25,000. That tells them, oh, you've gotten some money already, you're getting more money in, and today your business is expecting to get that money soon. That's part of your assets. We'll talk about that in a few minutes. Accounts receivable. Not everybody pays the money that is due you. Sometimes, or when it's due. Sometimes they take a longer time to pay it. 60 days. They're supposed to pay it in 30. Sometimes big companies say, we couldn't find a stamp. We can't mail the check. Nobody was here to sign it. The dog ate it. Whatever they say. What happens is you find out when you have a bunch of accounts receivable that they can get old. They start to get stretched out. Now the good business manager has to say, yikes, I better find out why we don't have very much money in the bank right now. I want to see a report that shows who owes us money and how old it is. How long has it been? You might go down a report for accounts receivable called an aging report that you see, whoa, we have a whole bunch of money that should have been paid to us in March, and now it's June and it hasn't been paid yet. I better get to work and start making some phone calls, sending some reminders, or find out how come we haven't been paid. Accounts payable is the money that your business owes to your suppliers. For instance, you bought some concrete. You're going to be doing some work. You bought a bunch of concrete, had it delivered to the site. You do business with the company, the supply company, all the time. They said, no problem. We'll give you the concrete today. You sign the tag. You're going to pay us in a month, or you're going to pay us in 2 weeks. We're going to send you the bill. You're going to pay us. And as long as you do, you have a good reputation of paying them. They'll say, okay, no, fine. You take the stuff, sign the tag, send us the money. At any given point, the amount of money that you owe to various bills are your accounts payable. You haven't paid them yet, but you got to write a check, send electronic deposit, whatever you do, and you have to pay those accounts. Those are your accounts payable. All of these accounts end up on something for what we call a balance sheet. When you have a balance sheet for your business, you're able to give this or show this or numbers from it to the taxing agencies. You're able to show it to the bank. You're able to show it to the insurance company so they can understand what your business looks like. Do you have a lot of cash? Do you have a little cash? All of these things a bank would find out about by looking at the balance sheet. And we can prepare a balance sheet for any size business. If you're a sole proprietorship or sole ownership like we talked about before, you're a one-man, one-truck company or a corporation, you can have a balance sheet. If you got 50 employees and 20 locations, you can have a balance sheet. They're both going to look the same kind of format as we saw on page 22. Let's go over to page 22 right now. Let's look at this balance sheet. A lot of numbers and titles and stuff can be confusing, but don't worry. This is simple. We can break this down real easy. We're going to identify the assets. Over on the left-hand side, we got at the top there, assets. We're going to identify that's where all the assets are going on the left-hand side. On the right-hand column, we got liabilities and owner's equity. At the top, liability, right under that, liabilities, that's the top of the right-hand side. That's another place where all the liabilities that we're going to talk about end up. Down at the bottom of the right-hand column, owner's equity, also called stockholders' equity, also called net worth. Down there in the bottom right-hand side of it is where all the equity values end up. We call this a balance sheet because if you go clear down to the bottom, the total assets, left-hand column, equals the total liabilities and owner's equity or net worth on the right-hand column. That's a balance sheet. For this company right here, ABC, $255,000 owners, total liability, owner's equity, $255,000. Total assets, $255,000. It's equal, it's a balance sheet. The basic balance sheet accounting equation that you get asked on a test about is pretty simple. The accounting equation is assets equal liabilities and owner's equity or net worth. Basically, it can be prepared for any size company. We just have to separate them out into the proper categories. Are we looking at something that's an asset? Are we looking at something that's a liability? Or are we looking at something that is in the net worth or owner's equity section? When you're a businessman, you don't have time usually to chase out and figure this all out on your own. But what you do have the ability to do is make sure that it gets prepared properly and regularly. Most of the time, companies get a balance sheet created at the end of a period, whether it is the end of a quarter, the end of a half year, 6 months, and the end of the year. Always definitely by the end of the year. In this way, we have the balance sheet as a snapshot, a photograph of what your business looks like on the last day of the quarter, month, year. And that photograph shows everything that we have divided up into assets, liabilities, equity. Now, it's not so hard to figure that all out. I know what you're thinking. Oh my gosh, how are we going to figure out all of those things? And I don't even know what owner's equity is. I don't even know how to get any. I don't know if I have any. I don't know. Don't worry about it. Real simple. We can prepare a balance sheet for you right now where you're sitting. Right where you're sitting right now. Current assets. Current assets are things that we expect to convert into cash within 1 year. Cash in the bank, of course. Accounts receivable, yeah, they should be paying us within a year. Retentions, yes. And prepaid expenses for the year. All of these things are current assets. Now, we have some below that long-term, non-current assets. Property, plant, equipment might not apply to your business. If you just have a small amount of tools in your business,
Your assets are your cash in the bank, your accounts receivable. You got some hand tools, which maybe you got a couple of power tools that are expected to last more than a year. Then we might be able to put that down into equipment. You have bigger things like a truck that you use only for the business. Well, the value of the truck is equipment. It's in there. Maybe you have one or two big pieces of machinery that you're going to use for many years. Those would be the full value in equipment over here. Office equipment, copy machines, maybe you have a printer that prints out plans. All of these things they're assets. They're not things that we're going to deduct in the year that we're doing it. They're meant for multiple years. They're assets here. We have those costs. We keep them in the account. Long-term assets, add those with your current assets. So current assets in the middle, long-term assets at the bottom there, total assets. You could have your own balance sheet that says, got my cash, got the money that's owed to me, I got $5,000 worth of tools. Okay, in equipment, that's where you got $5,000. Add up your cash, your accounts receivable, and your equipment. There's your total assets. You got the left-hand side of the column there. You're done. Liabilities. What do you owe your suppliers right now? Accounts payable. Remember, we bought those sacks of concrete. We got to pay for those. That was in December. They said we could pay that next month. Good. We owe money to the supply house for the concrete. Taxes. Well, if you have employees, you always have some payroll taxes due. If you know that you have taxes due as of the end of the quarter, December 31st, you figured out you got some payroll taxes to pay. You don't have to usually pay them until January, but you have the actual amount. That goes into taxes payable. Long-term debt, anytime we have a long-term loan or something that we have to pay back over a number of years, the portion that's going to be turned into cash within 1 year, current liability, goes in here, this column here. So we don't have too many things to put in liabilities. We got the money we owe, we got some taxes that we're going to have to pay, and a little bit of loan payments for a year. We'll put that over there too. Those are our liabilities. Okay. We know that we have our total assets. We got all of our liabilities. Let's pretend we don't have any long-term debt. We don't have any long loans or anything like that. Now, how do we figure out equity? Remember the accounting principle. Assets equal liabilities plus equity. Bang that around a little bit. You only need two numbers to figure out what the equity is. If we have the assets and we have the liabilities, the difference to get to owner's equity, adding and subtracting, it's got to be equal. That's how you figure it out. Owner's equity net worth is an accrued amount. It's amount that after you do all your expenses, all your income, subtract all your expenses, whatever's left over to make it equal is the owner's equity. It's a balance sheet. That's a very simple method of looking at a balance sheet, but every balance sheet for every size business operates on this same principle. These numbers could be bigger, there could be a few more categories, but they're always going to have assets, current assets, top left-hand side. Total assets, bottom left-hand column. Current liabilities, always going to be on the top right-hand side. Long-term liabilities, if they exist, they're going to be in the middle of the right-hand column. And owner's equity, stockholders' equity, net worth is going to be on the bottom right-hand column. It's always going to equal. It's a balance sheet. Once you have a balance sheet for your business, and it's real, you haven't made the numbers up, they're real numbers, then we can start looking at the balance sheet as a tool for us to figure out what's happening with our business. We can start figuring out whether our working capital is a decent amount, a good amount, a positive amount. Working capital is something that a lot of times banks want to know. If they're going to lend you money, they want to know what your working capital is. How much money do you have in the business that could be used? How we figure this out? Page 23, working capital equals total current assets minus total current liabilities. Total current assets. Where are assets on the balance sheet? Left-hand column. Current assets, total current assets, middle of the left-hand column. There it is. It's written out. It's a number. We got it. Current liabilities, same difference. Right-hand column, liabilities are always in the right-hand column. Current liabilities, up at the top, right-hand column. There's our number. We get those two numbers, assets minus liabilities, that's our working capital. Basically, it's saying cash in the bank, accounts receivable, retentions receivable, inventory, prepaid expenses, subtract what we owe, what we're going to pay out within 1 year, the amount left over, that's our working capital. Okay, we're going to talk next about the income statement. On page 25, talks about the income statement as another tool that we need to use for presenting what our business looks like. The income statement, or profit and loss as it's called, is how you will show whether we're making any income and making any profit for our business. And this is where we follow the format not unlike you've seen if you prepare in your income taxes, your personal income tax, a Schedule C. Schedule C in the income tax, you list your income, total income, sales, and you got a series of categories that you deduct as expenses, come up with an income at the bottom. Very much the same format. Right now, we're going to go over to page 26. Here's the income statement for ABC Construction Company, Inc. And you'll notice that this is the same company that we just looked at back on page 22, the balance sheet. The income statement and the balance sheet together, two forms of tool for accounting that we need to present our status. The balance sheet and the income statement are always prepared of the same date, as of the same date. You'll see that the balance sheet was the end of the period, December 31st. We come over to the income statement. This particular income statement is for the period December 1st to December 31st. But it could just as easily be for the year, January 1st to December 31st, but the end date will always be the same as the end date for the balance sheet, the end of the month, the end of the time period. Now we'll get into these categories. They're not horrible categories here. We'll kind of figure it out a little bit as we work our way down here. Once again, an income statement is where we show our profit and loss. We've got our expenses, we got subtracted from our income, and it'll show a profit. We use different terminology sometimes for getting steps along the way. At the very top, we have income, dark letters there, income. That is the sales. Basically, our sales could be prepared as a cash accounting method, or our sales can be prepared as of our accrual accounting method. We talked about that before. The cash or accrual has to be consistent throughout the balance sheet and the income statement. So we're going to get into some things called direct labor burden, materials used, direct cost, and come down after these cost of sales to a total cost of sales. Let's talk about direct labor. Whatever your business is, these are the wages that were paid to the people that are actually doing the job, getting your job done. Direct labor burden. We talk about the taxes, the insurance, the benefits that you pay as part of your direct labor as a burden. Material used. Material used, that's going to be usually the large purchases that you make. The concrete, the lumber, the steel, carpet and tile, paint, plumbing fixtures, electrical fixtures. If you're an individual subcontractor, any of these, you're going to be buying large quantities of because you have to use them on the job. That's what you're installing. Those are your materials used or direct materials. All of these things added together are your cost of sales. Total cost of sales means an amount for the direct costs, the ones that are associated directly with doing the work. We get to this case here, the sales or income was $200,000 and the direct labor cost is $155,000. When we subtract the 155 from the 200, we get a gross margin. Weird terminology, I know, but it is what the accountants talk about when they get to the first subtraction of cost, trying to get down to the bottom line. The gross margin is the difference between your income, your gross income, minus the cost, direct cost of sales, and we end up with the gross margin or gross profit as it's referred to sometimes. From that, we're going to subtract more expenses. Now, these expenses we're going to subtract now are generally in the category of what we would call an overhead expense. Overhead expenses are expenses that, yes, they need to be made in order to do the business of what we're doing, but they're not directly accounted for in each job. Things like advertising, interest, legal and accounting, office expense. You got an expense for somebody to sit in the office, open the mail, make sure everything is paid, make sure everything gets put in the right categories. You got utilities, you got the telephone and internet expense. You got some general taxes that you got to pay. Maybe you were in a certain city and you got to pay a tax to that city for having a business in that city. All of these things are what we call overhead expenses. Okay, so we move with all of these total expenses, we add them up, come down, all of these total expenses are summarized down here, $26,220. Those are what we would call our total overhead. We subtract the expenses from our gross margin up above, and we end up with net profit, the bottom line. Right now, this shows that ABC Construction Company ended up with $18,780 of net profit, about 9.3%, 9.4% of net profit based on their sales. Up there at the top, $200,000 of sales, that's our 100% number. Everything else is a percentage of our sales or income, 100% amount. For a sole ownership or sole proprietorship, the net profit, that's the amount that you're going to pay income tax on. If you're a corporation, we talked earlier about being a corporation. Corporations would have a net profit here. However, the corporation has already deducted the employee's expense up in either cost of sales or overhead expenses. So the amount of money that the corporation is paying tax on is less than what a sole owner would pay taxes on in this same scenario, because the sole owner's income was part of the expenses of the corporation. Let's get into a couple of analysis of the profit and loss or income statement. Up here on page 27, sales minus the cost of goods sold equals the gross margin. Yeah, we got that one already. We already saw that. Top line income or sales minus cost of goods sold equals gross margin or gross profit. We know where to find that. That's on our income statement. Gross margin minus total expenses equal net profit. Another simple one. Gross margin, that was what we found out before, minus total expenses, the overhead expenses, equals net profit, the bottom line. We got that one covered. We know where to find that. So when we have our net profit, our income, our cost of sales, let's see what we're talking about here when we divide them up, accrual versus cash method. We talked about that earlier, but I want to see it here as well. So we talked about income being recorded as of the moment you receive it, put it into the bank, or the moment you write the bill for recognizing the income as a receivable. Same thing with expenses. When we're on a cash or accrual method, all of these expenses would be cash basis. If we write the check, pay the money out, that's an expense. If we're on an accrual basis, we write the check, and some of the things are paying for stuff that are in the next period, like the insurance, which is going to be covering for next year, part of next year. That would be a prepaid expense. We wouldn't use that expense in the category of overhead expenses then. We'd only expense the stuff for this period. This period, December 31st to 31st, or this year, January 1st to December 31st. I just want you to be aware that when you choose the cash method versus the accrual method, that all the books have to be prepared using that method all the way through. We're going to start talking about these business management tools on page 31. Page 31, we got things listed like financial ratio and analysis. We go over here, we got current ratio and quick ratio. Holy mackerel. This is dangerous. What these are tools that are going to help us look at our income statement and our balance sheet and figure stuff out. Anytime you see ratio, think division. Ratio means division. If somebody's asking you for a ratio, there's two numbers that they want you to divide one by the other to get the ratio. If you're on a test and you're trying to find a ratio, think, okay, it's a division. I need to know what the two numbers are. I need to know where they are. When we get these tools working for us and we do them a number of times over a year, we can start to compare how we're doing in this period versus how our business did last year or the year before. We can say, oh, I know that my ratio of working, or my working capital, for instance, is this much now. A year ago, it was less, more, the same. And 2 years ago, I look back and it was less, more, the same. This can start to tell us how we're doing. When we go over on page 32, let's start talking about the current ratio. This is an analysis tool. And current ratio, okay, it's a division about something current. Here, right underneath there, we're talking about the current ratio is current assets divided by current liabilities, and it equals a number, usually a whole number and a decimal. In this case here, 2.42. The current ratio is a number that somebody would use to assess, as you could imagine, how easy would it be for your company to pay all the things that you owe due within 1 year with all the cash that you got right now in your current assets, retentions, inventory, and prepaid expenses. How easy would that be to do? In this case here, 2.4 says that we got $2.40 of current assets for every $1 of liability that we have. Okay, that seems okay to me. Seems like it's a better thing than if it were half of that amount. So the current ratio is a tool that, again, you can look at to compare where your assets and your liabilities are and use that to compare to other businesses. Banks would do this. They'd say your tile company has a current ratio of 2.4, and most tile companies with sales of 200,000 have a current ratio of 1.7. So you're doing pretty good. Going up to the top of page 33 right now, we're going to go look at another ratio very similar to the current assets over current liabilities. This one is called a quick ratio. A quick ratio is just a little bit more stringent, a little bit more intense, a harder test of that same concept as the current ratio. But here, they decide to take the inventory out of the current assets. We can handle that. We talked about inventories earlier as being maybe the value of of materials that we have in stock that we're going to be using on future jobs. But yeah, they're not quite the same thing as current assets, which is money receivable, or current retentions, money receivable. So in this case here, we're going to say, if we take our current assets and we subtract out the cost for our inventory, the value of our inventory from the current total assets on the balance sheet, we'll end up with another number, a smaller number than before. And we're going to use that current liabilities that we used before from the balance sheet on page 22. We're going to use that total current assets number again, divide those two, and we have a quick ratio of 1.8. What this ratio is telling somebody, us or a bank or a creditor, is that, yeah, we still have more assets than we do liabilities. Whew, that's a good thing. We want to make sure that we keep more in the assets than we have in the liabilities. When we say, okay, I got a quick ratio of 1.8, this means that for every dollar of liability, I have $1.80 of quick assets, current assets minus inventory, quick assets to pay the dollar of liability. Not bad. That's okay. Like I said, it's a positive number. If we are talking to a bank, we're talking to an insurance company, we're talking to some company, a bonding company that wants to know how strong our cash reserves are, this is how you do it. They want to see the current ratio, or they want to have the numbers to make the current ratios and the number to make the quick ratio. So we're still talking business management here. Remember, one of our goals as a business manager, one of our tools is to do planning. It's to do the exercise of keeping everybody going in the same direction. We're steering the ship toward the goal, and the goal is we want to make a profit, we want to stay in business, we want to be doing everything right. So, how do you get there? We got to do something like budgeting, planning for the future, figuring out how things are going to go. Most people think, I got some idea, but they don't go through the exercise of saying, I got this much income this month. I'm hoping I got this much income this next month. 2-3 months from now, I'm imagining it's going to be this much. And they start looking at expenses and saying, well, we got some expenses the same every month, and we got some that change depending on what time of year it is. And I look at those and I start adding and subtracting income and expenses 3 months from now, 7 months from now, and I see, whoa, there might be a cash shortage in the end of the year, or we might have a big bonus coming at the end of the year, but we're going to be having no money in the middle of the year. All of these are budgets that we need to do for our business. Our business, we can plan out what's going to happen in the future months, and we use our income statement as the basis for the budget. So we're updating the budget on a monthly basis. We can plan ahead. We're going to look at future expenses and future income in the format of our current income statement, like we had over on page 26, has got categories of accounts, charts of accounts on there, and we can use those as our basis. You'll notice everything listed here in this ABC monthly budget prepared in categories for the monthly budget column. These are numbers that come right out of the income statement expenses. Salaries, advertising, auto, depreciation, office expense, they're all in there. And we know what they are for the current month. Now, we can use that as a basis to say, all right, what are our actual expenses that happened at the end of the month? In the beginning of the month, we projected them to be just like December. And at the end of the month, after everything's done, we go back and we say, what was actually spent in these categories? Remember, you forecast something by looking ahead. You suppose it's going to happen that way. Sometimes things happen differently. And when you get that, sometimes things happen differently, and compare it to what's supposed to be happening, it affects the bottom line. In this case here, we have the plan, left-hand column, monthly budget, same as our income statement. And we've got our actual monthly expenditures. That's the reality. That's going to come from our real figures that for the month. When we start comparing the budget and the reality, we're going to be able to see, literally see, numbers that are big, that are different. Right now, we're going to drop down here. We're looking at some numbers, and we go, whoa, here's a big difference. Small tools and supplies, 3 times the budget. We thought that we were going to have small tools and supplies at $200, and we spent $600. Yikes, what's going on here? See, we're asking questions now. This is what a business manager does. A business manager looks at, says, this is different from that. Why? Now, you might know the answer if you think back to last month, but then again, if your company's big enough, you might have to ask somebody else, hey, why did this happen? This, again, is part of our regular management tool. We have regular meetings with our staff. We go over things to make sure everybody's on the same page. We tell everybody what the plan for the next time period is. It doesn't seem that hard to do it, and this is what we use as our basis. In the end, we see that our total expenses down here from the monthly expenses for $26,200, it's a little bit bigger than our planned monthly budget of $24,008. So right now, we know that if we've raised the expenses, what have we done with the profit, the bottom line? It's less. 1 month won't do us in, but we start to say we might have to adjust the budget higher or lower, or we might have to look at some of these expenses that have gotten a little bit bigger than the budget, figure out why that's happening, and see if we can fix that. All of this is business management. You start thinking of the bigger picture. If I have a plan, I know what I'm trying to achieve. That's what business management is. I'm trying to get us to go in the next direction. Some businesses that are having rocky times, their plan and their goal might be to get to next month. Get to next month with some money in the bank. You can budget, you can make a plan for 1 month. Some plans maybe stretch out for a year or 2. That's fine too. You can't get there unless you have a plan. Coordinate. You gotta coordinate stuff. You have to take these numbers, you have to figure out how you get them so they're good, consistent, real numbers. You have to get them on time. You don't want to wait, as I used to call it, the 12-month bookkeeping surprise, where you have the taxes due on April 15th and you think, oh my gosh, it's April 1st. I better figure out if I made any money last year. And you sit down for a couple of days and add up a bunch of receipts and numbers. Not fun. You can't plan unless you do this on a regular basis. We need to train our people. If you have a bookkeeper who knows what to do, that's great. If you have people doing your estimates, if you have people doing your project management that know what to do, that's great. You're on the roll. You're getting everybody going in the right direction. But if they're not, you have to train them. You have to say, whoa, 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 whoa. You can't throw all of these things into miscellaneous expenses. Miscellaneous expenses, $5,000 doesn't cut it. Miscellaneous expenses, there's too much. I needed broken out into our categories that we were using 3 months ago. What's the problem? That's what you have to do. We direct everybody as a manager to direct everybody on what to do. We don't want somebody coming here doing this one time and then going over there and somebody else comes over here and does a little bit. The job doesn't get done well that way. We want to direct so that everybody's doing a task to get to a common goal. This is work, doing this business management, using accounting. It takes time. It costs money. But without it, the odds of you succeeding in your business are really, really not so good. Without it, the 5-year survival rate is something like 37% of businesses survive 5 years. That's not a good deal. If you can increase your odds, how you increase your odds doing business management, there's a competitive advantage already over the rest of the people out there. The last thing in the chapter are the glossary of terms. I've thrown around a bunch of extra terms, and what terms that may confuse you, look them up here. The glossary is great. It'll direct you into what things are, find the terms you don't understand, figure out what they might be, a name for something else. Go back over the stuff. You're in possession of the tools to make your business be successful. Thank you. Hello, I'm Jerry Nelson. I'm here today to help you through Chapter 6, Operations Management. We're going to go over this and kind of cover a lot of the points that we need to wrap all of the training up. In the operations management, we're going to cover stuff that sometimes people assume is common, regular, everybody knows that type of knowledge, but we want to make sure that we go over it because sometimes not everybody knows it. Project management, that's what we're going to talk about. This includes job site management, the superintendent on a job. It includes inventory management, may or may not apply to your business, but in some form it might, so we want to cover that. We'll talk about security bonds, get into a little bit of what's going on with bonding, and estimating and bidding. Estimating and bidding, a very important part of being a contractor because that's essentially how you get your jobs. Finally, we'll look at the requirement, the necessary step that we do after we've finished a job, which is job costing. So right away, going to get into project management. I'm going on to page 2 right in your book, and we're going to look at some very important aspect of jobs. Everybody wants to know, besides how much it'll cost, is when's it going to start? How long is it going to take to do it? And when's it going to be finished? These questions are really important to the people that are hiring either you or the general contractor. Everybody wants to know not so much about all the little nuances, just when you're going to get done. To this end, all construction projects have a system of managing when the project gets done, a schedule. And the schedule is extremely important. Now, we have 2 types of schedules that you will run into, or you may produce for your project or be given for your project as part of the bidding process. The first one here called a bar chart, a Gantt chart. It's a real simple representation over a calendar period from here, May to August, of the different parts of the job in order to get done. Notice it starts with the delivery of rebar and ends up with installing equipment and cleanup. Pretty simple little confined job. And all of the duration of the task are kind of indicated there against the schedule on the calendar. It's important that everybody stay on this schedule because in the end, everybody's looking at August 31st, it's done. If anything happens along the way where it can't get done on August 31st, that's going to be a problem. You or some other subcontractor or somebody else doing the footings or erecting the walls, placing the roof, may encounter a problem. That problem, once you get the job, could be anything from, I can't get that material on time, to, we're awful busy and I'm not going to have anybody free to do that job at that time. This is why everybody does a scheduling chart. So you can look ahead, in this case here, look from May, June, July, and get your resources ready so that you know that you're on time and you're going to follow the schedule. So we're going to look at another method, which is down to the bottom of page 2, a critical path method. The critical path method is another schedule, that form of scheduling that usually is on a larger project, maybe a more complicated project, maybe a project that has a long duration, as much over a couple of years even, and may have a lot of different components to it. What we see on a critical path method is the entire project represented in these individual boxes called tasks. Each task that will be performed on the job will be identified in these boxes such that it has a early start, duration, early finish, late start, total float, late finish. Now, I'm not going to get into the complexity right now of setting up and making this kind of scheduling. For your purposes, if you're a contractor, you're given a critical path method schedule, you want to be sure that you locate your activity. Whatever your activity is, it will be there somewhere in this entire chart to look at and say, oh, I'm going to be doing tile work, so I have to look at the bathrooms, finishing tile by a certain date. Once you have that, you see where it fits into the entire project. Mind you, the entire project is filled with a number of tasks. We have to be sure that our task, our piece of the project, doesn't hold up or cause a delay for everybody else after our task. For instance, if our task were labeled down here at the bottom of page 3, task F. We're going to pick out task F right in the middle of the top line here. This is on the critical path. What this means that task C, task E are going to get done before us, and task H, J, and L follow our work. We need to get our work done right in that time period. You usually are given the critical path schedule at the beginning with your contract documents. You sign the contract, you have a go-ahead, you start immediately seeing on the critical path that measurements and specifications have to be completed. You need to put in your drawings by a certain date. You need to have approvals by a certain date. You need to order material by a certain date. To you, that might seem awfully early, or it may seem too late. It is your job when you are on a project with a critical path, or even the bar chart method with a schedule, that you inform the general contractor or the owner or the architect if there's going to be any problem meeting the schedule. These tasks can be broken down in their duration by hours, by days, by weeks. The whole concept with a critical path method scheduling is to make sure that a project can get done, complicated project, get done with the least amount of in the least amount of time. In other words, everybody does exactly what they're supposed to. It takes exactly as long as it's supposed to, and they get finished on time. Everybody knows that doesn't really happen, but it's important because the schedule, the end date on the schedule is on the contracts. Now we're going to talk about job site supervision, going over to page 5, and keeping the job on schedule usually falls to the responsibility of the on-site superintendent at a job site. Because we're a construction company managing different job sites, we have to appoint or have someone at the job site managing, watching, understanding how the job is progressing, while we, the general contractor, the specialty contractor ourselves, might be in the office bidding on other jobs, doing other job site visits, etc. So in general, at the job site, there's lots of stuff going on. We have to know for our company, our trade, who's in charge, who makes decisions on site, change orders, anything that affects the delivery times, delay of extra time, delay, extra cost. These are things that have to be able to be decided and known about right away, and those happen at the site. For this purpose, the general contractor or the specialty contractors have to have somebody there that has enough authority to make these decisions, to keep the project on time, on the schedule, and so that you, as the contractor, are aware what's happening day to day. You can't go to the job site on the first of the month and not come back and find out what's going on till the first of next month. That's too much time. That's why we have to have somebody on site responsible for paying attention. If the job's not ready and our work isn't ready to be done yet, we still have to visit the site to know whether or not they're making the progress so we'll be ready according to the schedule. At the top of page 6, the supervising manager might be somebody you as a contractor designate. You might have designated a responsible managing employee or a responsible managing officer when you created your business that was in charge of the actual work. In this case here, those people are the ones that have to take the responsibility for keeping things on schedule. When we go to the job site, it's our responsibility to check the quality of the work. If we're doing work that we're doing tile work or we're painting or we're doing drywall, we have to make sure that the work we're doing is of a good quality, of a consistent quality, of the quality expected in the contract documents, in the specifications. We have to make sure that the work is being done legal. You can't have your employees out there working until the middle of the night or working in really early hours because the legal requirements might be that no work in the city can start before 8 a.m. or before 7 a.m. and it must be done by 5 p.m. These are things that you're responsible for. Communications. You're responsible to make sure that all information about your part of the project gets communicated effectively to the general contractor, to the architect, to the owner. If this doesn't happen, you're in a vacuum. You're making stuff, you're building stuff, and find out, oh, somewhere along the line a change order happened and this is supposed to be different and I didn't get the memo. Not a good program. We have to have active communication. In general, this means you or your responsible managing owner or employee officer or employee has to visit the site on a regular, maybe daily basis, just to make sure everything is covered. We're going to talk about inventory control. Now, inventory control, right away people say, what, I'm not a store, I don't have inventory. Well, in some cases that's actually not true. Many times, because we don't keep all of our supplies at a very big level, we try to keep them at a minimum level so we're not having issues like them disappearing, getting broken, becoming obsolete, not ready when we need them. We want to keep a certain amount of inventory so that when the job's ready to go, we have the stuff already. If you've bought some materials for a job and the job is still in the dirt phase and there's no storage at the job site, you're going to keep them at your warehouse or your office facility, and they're going to be inventory. Now, when you have inventory, it reduces time and expense in handling the material. It can reduce the issue of all of a sudden you need to do the work and you don't have to go out and drive to the yard, pick up some material, pick up these things. They might not be in stock, take them to the job site and ready to go. That's a good benefit of having your inventory in stock already. Some downsides of having a large inventory is that you have less profit. It takes profit or money out of the business to purchase the inventory and hold it sitting, waiting till it gets used. So if you have a very large inventory, that could be a big drain on your profit, a big drain on the cost of your business. When you get into keeping the inventory, if you just take, I don't know, maybe you had to go and buy 25 sinks for a project. You got a project coming up, you need 25 sinks. They all have to be round sinks. They got to be a certain pattern. They got to be ivory sinks. You go buy the 25 sinks you're going to need on the project. You have them shipped to your office. You open up the storage locker, put the 25 sinks in, close the storage locker. We don't need those until next June. We're good. We have them in stock. In the meantime, we have to make sure that the stock is okay, that it's still there. We may have to have somebody go out and take inventory 3 months from now, 6 months from now, just to make sure that that stock is still there and in good shape. While we have our stock in there, maybe you need to get some inventory or storage of some other things. It gets brought in, put into the same warehouse, same storage locker, lock it up. We're good. Now we got 2 jobs worth of inventory in there. The other job gets taken out and our sinks are still in there. 3 months later, some more inventory arrives, some more sinks, some more toilets, they arrive. We put them in the inventory locker. We come back another month. Those go out. We come back a couple of months later. It's time to start taking out those ivory sinks. We think we have 23 in there. We go in, we find out, wait a minute, there's only 19 sinks. What happened? Worse, you think you're going to the job site, sending somebody with 23 sinks to go install tomorrow, and you only have 19. Uh-oh, now you have a big problem. Now you have inventory that has been misplaced, went to another job, got broken. In the end, this is going to cost you more money. Now you have to go figure out how to go get some matching sinks right away with matching the 23, bringing you up to the 23 you already need. These are just a little example of things that can happen with inventory. Some people keep inventory very specifically in a locker. Some people keep their inventory supplies on a truck. You might have a business that has a lot of compartments in the truck and you say, we're just going to put a lot of pipe and we're going to put a lot of nuts and bolts and fasteners on the truck and it'll just be there. But here again, if somebody doesn't come out and actually count the inventory, take a stock of it to make sure it's in good shape, to make sure that nothing is broken and been put back in, to make sure something wasn't used on another project and not replaced, and make sure that your inventory matches what you think it is. Now, it's not a big deal if we're only talking a couple of things, but as you can see, the bigger the inventory gets, the more chances you have to have problems. So inventory control, very important practice, a very important part of managing your business. Okay, we're going to go over now to page 10 and talk about the surety bond. We're going to right away understand that there are different kinds of bonds that our business is going to bump into. Everybody knows that as part of becoming a licensed contractor, you have to post a construction license, a contractor's license bond. That bond I'm not talking about. You already know about that. That's a requirement that you have to just to be a contractor. In this case here, these are different kinds of bonds that you will run into later when you're in the process of your business. In this case here, we're going to cover things like a bid bond, a contract bond, a payment bond, a performance bond. Any of these separately or all together could end up as a requirement on a project that you bid or a project that you take. You will know about it before it happens. If it's a requirement that there be a contract bond or a bid bond for your project, it will be in the specifications for the job so that when you go to bid on it, you'll know about it beforehand. Basically, you get your bonds from an insurance agent, somebody that you use for your insurance policies. You would be able to go to them also to purchase a bond. A bond is something that's a form of guarantee. So in this case here, if we have a contract bond, the buyer on the contract wants to make sure that the work is going to get done and that all of the subcontractors or suppliers are going to get paid. Then they may specify, we want you to do the project, X amount of dollars, want it done by this date, here are the specifications, and we need a contract bond. Well, you might be thinking about, yikes, what's the contract bond? But sure, I want the job, okay, I'm doing it, fine. When you go find out what a contract bond is, you'll go to your insurance agent and you'll ask them, how do I get a contract bond or a payment bond or a performance bond, and what's this all about? Usually what happens is the insurance agent will be able to hook you up with bonding companies that will have requirements to know whether or not your company is of sufficient quality to bond, to guarantee. You have to be able to qualify for a bond. Bonding company isn't going to accept your word that you're a brand new contractor, you've done a couple of projects for your mother-in-law, finished them on time for budget, so you're a good contractor. They need a little bit more than that. Bonding companies will use, as we discussed in Chapter 5, your balance sheet and profit and loss to judge how strong your company is. They also want to know about your reputation. How many jobs have you done over how much period of time? What size projects? What other bonding experience you have? In general, what a bonding company does is it promises, for instance, that on the contract or performance bond, if you as a contractor fail to complete the project, you don't do your work, you get mad and quit, you don't come back to finish the job, that the bonding company will make sure that the job gets finished, that your task gets finished. what they do is they will go out, hire another company that's reputable, and finish up the project. The bonding company will pay the project, the new subcontractor, pay them to get the project done. And then the bonding company says, now we're going to go find you and figure out how you're going to pay us back. So just because there's a bond and because you bought it from your insurance agency, it's not a means for you to say, oh, I don't have to do it, the bonding company will do it, I'm off the hook. It's not insurance. So new contractors qualifying for a bond generally will have to have a good record so that the bonding company will tell you how much your premium will be for buying the bond. Sometimes the premium, and it's usually a percentage of the bond, might be 1%. It could be as high as 4% or 5%. In general, the less experience you have, you're going to pay more for your bond percentage. 4 to 5% is not uncommon. If you have a lot of experience, you've got a good track record, a good reputation, the bond cost will be lower. We do want to know what our bond cost is going to be before we sign the contract, so that when we have our costs together, we can include the cost of the bond in the contract. Now, some bonds, a bid bond, a contract bond, payment bond, performance bond, sometimes these might be paid, the premium might be paid by someone else. It might be paid by the owner of the project. The owner of the project says, yes, I know I want to have everybody bonded to finish the project. I'll pay 1% or I'll pay 2% or the cost of the bond in your contract. I'll pay for that extra. Or the general contractor might require the bond of your company and say, well, tell you what, we'll pay for the bond. We want you to do it. You're a good specialty contractor. We recognize you don't have very much business experience. We'll cover you. We'll cover the cost of your bond up to 2% and get you on this job. Next, we're going to jump over to page 12 and talk about estimating and bidding basics. Estimating and bidding, there's a difference between this. Let's understand that in the beginning. You prepare an estimate, which I call a guesstimate, where you round up a bunch of ideas of the cost that it would be to do a project. If somebody wants a parking lot paved, you might say, okay, project that size, how many square feet? Okay, I guess that it'll be about this much. My estimate, it'll cost you $10,000. That's an estimate. It's a guess. It's taking the approximate amount of cost that you're going to have and just giving that cost as an estimate to somebody considering to do the work. A bid, on the other hand, is a formalized price. It's a firm price that you write down, fill out all the specifics of your bid, what you're covering, what you're not covering, when you're going to do the job, how long it's going to take, what quality you're going to do, and you submit the bid to the owner or to the general contractor, to the architect, and they will be the ones that decide your bid is a good bid or it's too much, you bid too much, too low, whatever, and they might compare other bids to see which is the best price, which is the best value. Always we talk about making sure that when you're doing a bid or an estimate, you make that clear to whoever's asking for it, whether it's an estimate, it's not a firm price, or if it's a bid, it is an exact price that you or company will agree to do it for. Gathering up your cost. We're going to talk again about direct and indirect cost. Direct cost for a project are going to be the expenses, labor, materials, equipment that are going to be attributed to that project. If you're going to build something, you know exactly how much material you need because it's 20 feet, it's 50 pounds, it's 500 feet. You know the quantity because you know what the job is. You can guess about the indirect cost as a percentage. You know that when you do a certain amount of work at a certain period of time that you have overhead, indirect cost. These are the office expenses, the supply, the cost of traveling back and forth to the office, the bookkeeper's salary, the estimator's salary, things that are not part of the job. Those are your overhead costs, your indirect costs. You can figure these out using a couple of different estimating methods. When you're preparing a bid, two different methods might be: one, the stick by stick or stick method, the other, the unit cost estimating. Both of these are ways that you would have somebody look at a set of plans, measure a site. Somebody might say, okay, we're going to this site. I've got this area right here. I want to landscape it. I want to just get a couple ideas about how to fix it up, put a curb in, put a sidewalk in. That's what I want. Once you have the quantities, you're able to say, okay, we measured it up off the plans. There's 75 feet of curb, 4-inch curb. We know that they want a half a dozen trees out there, 6-inch pots, 10-inch pots of trees. We're good. They want a bench out there. We got that. We could figure out all the costs that we need and write them down, get a price from the supplier, how much they'll cost, and we're preparing our bid. We're getting our pricing, our cost, direct cost together. Sometimes contractors might want to use a little quicker method, and it might be something as unit cost. You know from your past history or maybe working for somebody else that it's $10 a foot or $200 a ton or $400 a square foot. You might use those figures and toss them around as a method of bidding because you're pretty comfortable with, yeah, you kind of sort of know that that's what it costs your company to do. You're in a hurry. It just there's 75 square feet. Yeah, we're going to use $400 a square foot. We got it covered. It may be good, may not be. I mean, if it works, it works, but it is another method to preparing the bid. So again, it's important that we have to get our quantities based on whether we use a stick method or a unit costing $10 a foot method, whatever we do, so that we can make the presentation in a legal form of our bid to get the job. We're going to go look at, on page 14, what we have to do continuing this process of estimating and doing the bid. You must review the plans or whatever you've been given so that you can see that it's complete. You have to be able to know what the customer wants, what the job is. We often talk about the specifications, plans and specs. When you give a bid to a general contractor, to an architect, to an owner, we always talk about we're bidding per plans and specs. This means that, yes, I got plans, drawings from you, the architect, the owner, or your agent. I got a list of specifications. It might have been very simple, 1 or 2 pages of specifications. It might be very complex and it's 300 pages thick specifications. But when we bid, we have to know that we have covered all of that material before we give our price. If you're just going to look at it and say, oh yeah, that job's worth $10,000, let's bid $10,100, we'll be good. And you bid that way, well, that's pretty risky. If you're the only bidder and you know what you're doing, maybe it works out. But if you're bidding on a project where other people are going to look at that and say, oh, wait a minute, Did you know that the tiles were 18-inch square tiles on that floor, and they're not 6-inch? Ooh, didn't catch that. Well, that was in the specifications. You need to know that. It's very important that you, as a bidder, a general contractor, a specialty contractor, don't assume that you know what they want on the job. You need to follow through on the specifications, and they may have made a mistake. May have specified something on the job that doesn't exist anymore. Maybe they specified an old product. Maybe they specified something that they want one of, but the only way to get anything is you have to buy 600 yards of it or something like that, but they just want one. These kind of things happen where specifications might need to be challenged very early on while you're estimating or bidding the project. If you have inaccurate specifications, that's going to be a whole can of worms that'll continue to plague the job all the way through, ultimately leading to you as a business manager are not going to be able to get paid what you think you should, or get paid by the owner of the project because they weren't happy and decided that you didn't fulfill your contract. A lot of trouble that can be avoided in the bidding and estimating process. Job walk. Once you've gotten your plans and specifications, gone through them, gotten familiar with them, you need to do the job walk. Only doing a job walk can you get a clear picture. It might look perfectly fine. Oh, it's on flat ground, there's a street all the way around, and there's a place for me to park my truck right in front. That's what it looks like on the plans. When you get there, you find out, whoa, this is on a busy street. There's no parking from 4 p.m. to 6 p.m. There's 30-minute parking during the day, and there's meter minders out here 24 hours a day. They're going to tow anybody away that stops their car right on the sidewalk or at the sidewalk line. Yikes! I didn't know about this in the specifications. I didn't know about it in the plans, but when I did the job walk, that's when I saw it. All right, so now when you've done your walkthrough, you've got your quantities, you know your costs. We want to make sure that we've got everything that's involved. If we have work that's going to be done by subcontractors to us, to our firm, then we want to make sure that they go through this same process we do. We want to make sure they review the specifications, or we tell them about the specs on the job. We want to make sure they know that the project's on the 4th floor penthouse level. We want to make sure that they give us, the contractor, a firm bid. So just like we're going to give a firm bid, we want to get our cost all figured out and put in writing before we get our bid in. So we want to get our quantities to a supplier. If we have somebody going to be doing subcontracting work, we want to get them on board to give us a price that we can put into our bid. And the next thing we have to figure out for our bid is our labor. Labor is usually one of the harder things to come up with. We have to guess how many hours it's going to take the guys or the crew to do something. If they're pretty good most days with working and getting 100 feet done, or 50 feet a day, or 3 rooms a day, or however you're going to guesstimate how long it's going to take them, you're going to need to come up with a number that matches the rest of your bid so that you're comfortable with it. You're going to use your labor, direct cost for the labor per hour or per day, however you're bidding on it, with as close a guess as you can to ensure that your pricing is right. When you have the materials, usually the biggest quantity is the materials, you can do that pretty accurately. We're going to look at what equipment we might need to do the project. If we have stuff already in stock in our equipment of tools, we don't need any more tools or any special tools, that's good. We're okay. But we might say, to do this project, we're going to have to rent a certain kind of tractor, or we're going to have to make sure that we can transport this. We're going to have to get a shipping agency, or else we'll have to buy a truck or rent a truck to get the materials over there. All of these things that need to be considered for the bid for the job. You can't go back after you have a contract and say, oh, I forgot, we don't have any shovels, and we have to buy shovels. You know, they say, what? You gotta have shovels? You're a contractor. We're not gonna pay for extra money for you to get shovels. So these are things that we just want to make sure that we have all our costs together for the project. We'll talk about government fees and permits as something that can happen depending on where your job is. Like we talked in Chapter 5, sometimes there's licensing or permit fees that you have to pay to governments to do business in their city. If you're going to be doing a job in another city or another district, you may have extra taxes that you have to collect as part of doing work in that city or that area. So we want to make sure we cover those costs as well. Now we're talking about project overhead, top of page 17. Project overhead, we've got overhead items, which again are indirect costs, costs that we have incurred or we will incur to support things that are not actually used on the job, on the direct labor for the job. A good way to go capture where those costs are, where they have been, is to go back to your profit and loss, your income statement, and look those up on your income statement from the previous year, year to date, and be able to get a sense of what those costs generally would be for the duration of this project. We spoke earlier about bonds and how certain kinds of bonds required for this project might be an additional cost that you have to put into your bid, because you have to be sure to cover that as long as it's not being covered by somebody else. The 2% for the surety bond for contract or performance bond. You may have found that in the specifications that you might have to have additional insurance. Something that would be a normal situation that you would have your insurance cover might not be covered on this particular job. Perhaps it's in a location that is requiring special insurance coverage, or perhaps you're doing a job that has you working at night and you need additional insurance coverage to be able to be having your project done at night. Whatever the extra coverage would need to be, that would be another overhead cost for this project. Another step down the road here is called contingencies. Very, very difficult to come up with a contingency amount. But in general, that's an idea that what if things don't go the way they're supposed to? If the project you're doing is pretty straightforward, you've done it a bunch of times, that kind of project, you know what's going to happen and how it moves through. Perhaps it's a project that it's a phase of a project. You've already done the first phase and doing the second phase. You know a lot of stuff about how it's going to work. You may have a smaller contingency, a plan for what if something doesn't go right. What if there's a cost of extra material because of stuff gets damaged in transporting it there, or if you have a cost that you're not quite sure of because the specification wasn't, could be interpreted one or two ways, and they may decide to do it one way or the other, and you just want to cover yourself with, well, what if they order that they want everything 10 foot long instead of 8 foot long, and you have to get an upcharge for that? Well, contingency. You might investigate that and have that as a cost you want to put into your bid. Going over to page 18 now, we've gone through these steps and we're at a point where we can determine the estimated job cost. We've added all of these numbers together, and now we'll be able to say, okay, I got an idea that to do this job, it's going to cost this much. Good. Couple more things we have to consider before we get to the final bid. We got our costs together, we got our labor estimate, we got our subcontractors, we got our permits, our materials, our overhead. We're in pretty good shape, but we're not there yet. In general, a format for preparing this and for determining our final selling price, our bid price, is to use the estimated job cost as one category, and then we assign it as a percentage of the total bid price, sales price. We're going to have our company overhead, which is there all the time, whether we get the job or not. We still have our overhead for the company there, the office salaries, the rent on the office, the bookkeeper, the estimator, all of those people, our office overhead. We have that we can express as a percentage. Usually when you know your overhead cost, you already have an idea of what that percentage of sales is from the income statement. We talked about in Chapter 5 how the income statement, the profit and loss, groups the expenses so that they have a total indirect cost or overhead amount on the profit and loss, and that's expressed as a percentage of total sales. In the example here, it says overhead percent equals annual overhead divided by annual income, gross revenue. In other words, that's exactly what we get from the profit and loss or the income statement. Another good reason why we want to have current, properly prepared balance sheet and income statement. Yet another example of why we might need to use the figures there to run our business. When we figure out our percentage of overhead, we know that for every $100,000 we do, our overhead is generally a certain amount. We might say it's 20%. We know that everything we do, we generally have a 20% overhead figure in our business for every $100,000 or every $100, whatever it is, of work, of sales we make. We're going to use that percentage in a minute to help us figure out the rest of this bid. So we're developing a ratio here. We're developing a ratio of what our profit and our overhead and our total cost are going to be of the selling price. The eventual selling price is the amount that we're going to say, okay, we took the plans, we took the specifications, we figured out how much it was all going to do that. We added some overhead, we put in our regular profit, now we got a number. That's what we're going to bid, or approximately that. How we get there, everybody's got different methods to do it, but we're going to follow this because in general, Contractors License Board assumes that we're all doing this the same way because we all have to end up with a bid in a proper format that we give to a general contractor, or we have to bid to an owner, get a contract, sign the contract, and do the contract, and eventually look to make sure that it worked out that way. We're going to try and calculate the selling price right now. So I spoke of, we've got these piles of cost up here that we're going to put into one number. And if it were real straightforward, a machine could do this. In fact, there are bidding programs, there's estimating programs that you can plug in a few quantities and numbers, push a few buttons on the machine, and it says, okay, here's your selling price. Well, you're getting that price from your quantities and costs, but your competition is also getting that price from their quantities and costs, which may or may not be exactly the same. You can follow down here in the bottom of page 19 to get through the calculations to come up with the selling price like they do down here. Again, what they're doing here is they're taking the 84. They know that. They got that together with the stick method or a unit price method. Overhead, we came up with that number because we used it off our profit and loss. 10% profit, that's our target. We make all of those equal 100%. Now we got a price of, in this case here, $120,000 as our selling price. Technically, that's the selling price because there is a certain amount of competition out there, and we're just kind of getting a sense of what we should be bidding, what it might be we think the owner might be looking for, what we think maybe our competition might be bidding a number, and we want to take a chance. We want to take a risk. We really want this job. Maybe on this one job, we'll adjust our selling price to get the job. That's okay. That's okay. That's what the bidding process is about, the competitive bidding process. You, as a business owner, calculated it out so that you would make a profit, 10% profit, you got your cost, you got your overhead covered, and then you decided, let's take a risk. And I'm going to take a risk that maybe we drop 5% off the total price and we're going to get the job and it will be good. That's okay. The important thing to remember here is that you did that, because when you get the job and it's 6 months from now, toward the end of the job, and you start looking and saying, whew, the profit margin's awful tight on this one, you'll have to remember that you took a risk, and that was one of the factors that you adjusted the bid price to get the job. Okay, to summarize, we've taken the steps of the things we know, and we've worked through this little formula here to get to our selling price. Right here on the bottom of page 19, I got them steps 1, 2, 3. We took 20%, which was our company overhead, plus 10%, our company profit. That equals 30%, 20 and 10, that's our markup. Step 2 here, we know that's our markup, so 100% will be our sales price, minus 30% equals 70%. That's the job cost, 70%. We do the calculation, 84,000 divided by 70%, 0.70 is expressed as a decimal, equals 120,000. That's our sales price. Okay, so we're going to go to page 20 now, item 14, and talk about retentions. Not everybody who's a contractor is familiar with the concept of retentions, and that can be a big surprise if you don't realize what it's about. Retention is a delayed payment. You've done the work. Everything's done. Everything's good with your work. You've had to sign a whole pile of releases, lien releases. No, I don't have anything outstanding. Yes, all my suppliers have been paid. Yes, all my employees have been paid all the wages they're due. You have to sign that stuff, give it to the general contractor, or give it to the architect, and they give it to the owner. And when they've collected all of those things, they say, okay, now we're ready to release the retentions. In general, we know about this beforehand because it's in the contract documents. Already when we looked at the specifications, we saw the contract document that we would have to sign, and we knew already that they were going to have a 10% retention on this project. The 10% retention means that they're going to get to the end of the project, going to have a final date of completion. Building inspector is going to sign them and off and say, okay, you can occupy the building, you're all set. And they're going to wait maybe 30 days, maybe 60 days, maybe 90 days. And once they're sure that nobody's filed a lien, nobody's filed a subcontractor lien for wages, for a non-payment, everything's complete, then they'll give, upon billing, the payment amount for the final 10% or retention. Regular private projects, 10% is a pretty common number for retention. Government projects, usually 5% is the number for retention. You may remember that in Chapter 5 on the balance sheet, we had a special category that we put these retentions receivable. It's money that we've already earned, we've already done the work, it's going to be paid to us, we have a contract for it, and it's listed on the balance sheet as a special kind of receivable. We had accounts receivable above it, and below it we had retentions receivable. That's the sum total of all of these outstanding retentions that we have on different projects. One of the things to consider if you're working on this project and you have retentions is where you are, your business, in the construction project, in the life of the project. If retentions are not released until 60 days after the final completion, everybody knows that, that's fine, but let's look at two different contractors on that job, two different subcontractors. Let's look at the example of a clearing and grading subcontractor who came in the very first week of the project doing clearing and grading of the lot, finished the work. If it's a 24-month project, 2-year project, finishes the work in the first or second month of the project, sends a bill. The general contractor pays 90% and says, oh yeah, we got 10% retention. You don't get that yet. When do you get it? 60 to 90 days after the end of the final project. So in this case, the clearing and grading contractor is going to get 90% of their money within 30, 60 days, and then they have to wait till the end of the project. This year's a 2-year project, 24, 26, 28 months later, gets the final 10%. Whew, okay, we want to know about that because that could affect our cash flow. If we have to wait for some money, it's coming to us, but it's not here yet. So we might have to make an adjustment for our cash flow knowing this on this bid. So it's important that you realize where with retentions you are in the life of the project and when you can expect to get that final retention amount. Not all projects have retention. You will know about it because it will be in the contract documents, it will be specified in the specifications when you're bidding at the beginning. So that's why this is here. Don't forget about retentions. Finally, we get to the point of submitting the bid. You have all your documentation because when you submit the bid, now things happen and they're all out of our control. It might be things like the owner is reviewing the project and saying, oh, I want to do this, but oh, that's too much, or maybe we'll do this, and negotiations are happening, and suddenly it's 3-4 weeks later and you get a phone call. We're reviewing your bid, you're a apparent low bidder, but can you give us some breakdown on the materials cost? So they might want you to look at and make sure you have all the amounts that were listed on the spec. Or you might have included something that didn't seem right to them and they want to make sure you didn't read the specification and substitute some material that was going to be more costly, for instance, and your bid could be lower or higher, whatever. So this is something why you need to save your documentation from your bid to be able to answer questions later on as far as how you determined your cost, where your quantities came from, what you actually bid on, whether you included or didn't include a certain portion of the project. And when you do that, you'll be able to, again, address it, but you have to address it in the same format that you did when you were preparing the bid. Let's get into common estimating and bidding mistakes. That sounds like fun. What kind of mistakes happen in estimating and bidding? A lot. It happens a lot. As you can see, this is not a real solid, that's how much quantity we have, that's how much labor we have, that's how much profit and overhead, that's the number. Things can move around because it's an estimate. We're not quite sure all the things are going to go the way they were drawn on the plans or the specifications. Even though we made a job walk, things could still be different. Vague specifications. A lot of time you'll find out the more information you have on what somebody wants you to bid on, the easier it is. Example of a note you might find on a set of plans. Replace existing stairs. Arrow. And that's all the information you have. Replace existing stairs. Okay, I got that. We'll throw a couple of 2x and get out there, put up a stair, just like what they got. It'll be great. Let's maybe go a step further, and the note says replace existing stairs with precast treads by ABC Company, product 1427A or equal. That's a lot more specific than replace existing stairs. So now we know that when we're bidding on replacing the existing stairs, we got to use the product they specify or equal. And that sometimes is a problem. Sometimes we have to find out, hey, we're going to bid an or equal, and will you accept our product that we're bidding with as an or equal? Another one, cost. You find out after the bids are in, your costs are too high. You're bidding with a 30% markup. Everybody else is bidding with a 25% markup. You keep getting priced out of the market. What can you do about this? Well, now we have to start looking at going back and figuring out what is too high, or is my overhead too high? Maybe I have too many people in the office estimating jobs and doing bookkeeping and sweeping the floor and the janitorial staff, and maybe we got to cut a few corners here on the office overhead so that we can get our costs down a little bit more in line with everybody else. Not enough profit. It always seems like profit's what suffers. We got to pay for the material. There's no two ways about it. If the job takes longer, holy mackerel, we hit a big rock in the middle of the thing. It took 3 guys 2 days with jackhammers to get that rock out of there. I only thought it was going to take 1 guy 1 day. Whoa, we had all this extra cost, but we can't recover it because we gave a bid and we accepted the conditions. So we have to pay our labor. Overhead. For the most part, you got to pay your overhead too. You can't tell the PG&E or the utility company, you can't say, we didn't make any money this month. How about we only give you $20 instead of $150 for the electricity for the office, huh? Is that good? No, that's not happening. So the thing that suffers in all of our cost and our bid is there's not enough profit. Yikes. That 10% profit we were looking for, it might come in at 1% or 0.5%. Maybe it comes in at 2%. This over time will be a problem. We will start to see this number show up in our profit and loss, our income statement. We'll start seeing that, gee, we're working really hard. We got all of this sales going on. Everybody's working full time all the day long. Everybody's working hard. And at the end of the day, end of the period, we got this little tiny number for profit. That's not going to work because essentially you're going to be to the point where if you don't make a profit, you can't stay in business. You can't increase your business. You're not going to have enough money to cover your costs. Another thing to consider is the owner's financial ability. The owner has already considered our financial ability, whether they ask for our resume, whether they decided that only people who had been in business for 10 years could bid on the project, whether they needed us to get a bond. We can't do that with the owners. If you're working for a company or an individual that maybe has a history of not paying their bills, you want to make sure you find that out before you take the job. Back when we're doing specifications, how do you find that out? Something like that, if they're a company, you can run a credit report as a company on another company. Your company could request a credit report on the owner of the project just to see if they have enough assets, if they have a good history of paying for contractors making improvements. You might be able to get that information from other suppliers and subcontractors that you work with. Somebody might say, oh, I never do business for the people over there in that place. That house, man, they stiffed everybody last year on another project and I'm never going back. Good information. You don't want to take a chance on taking a job you don't get paid for because you did the job right, but the owner has a way of getting out of it, not paying it. At the end of the day, everything's finished. We've done the job. We've gotten paid. We've got our retentions. We're bidding on other jobs. We have other projects going on. We want to sit back at some point and do some more management. Remember, that's what this whole thing's about, managing the process. We have to spend time with our business records and do a job costing analysis. We want to look at the job, how we came up with the cost, how we came up with the overhead and the profit, what actually happened, and see if things worked out. When we do this on a regular basis, we start to build a reference so that we know that certain kinds of jobs, maybe using certain kinds of materials, or maybe jobs that are done in a certain distance away from the office, that we've got the right cost, that we've got the right selling price, and things are good. Or maybe we figure out we're missing a little bit. We're overestimating some things and we're underestimating the others, and it's just kind of working out okay by luck. Job costing would be a process of systematically reviewing all the labor, the material used on the job. You want to compare that with the estimate. Remember the bid that we prepared, I said it had to be in good format, and we had to save that because now 6 months, 2 years, wherever we are down the road, when we want to look at how well we did, we need that original estimate. And we want to look at it and say, okay, we did a takeoff and we used $10 a square foot, and okay, that sort of worked, but you know what, maybe we should have used $10.75 a square foot. That would have been a little better price that we should have done. And okay, maybe we're good, but you need to go through the process. You might start looking down and saying, man, the last 3 jobs that we looked at, we completely blew the labor. Completely. Every time we estimated it was going to take 80 hours, 100 hours, it ended up taking 25% more. Again, something that you learn from your previous estimating, your previous bidding, and doing the jobs and comparing them. So all of these management tools are things that you need to do to stay in business, to make sure you keep on making a profit. You would be able to use this information as a guide for your next project that you bid. One of the nice things about being a contractor, a licensed contractor, is you don't have to do the same thing every day. All the jobs are different. You get to find something new on a job every day. Never had to do it that way before. These job specifications are crazy. This is going to be interesting, yes. But we need a guideline to get us there. Well, when we had a project that we didn't know what we were doing before, we increased all the labor hours by 10%, and that worked out okay. Good, we're good. Okay, we're going to try that. when you're in business, you use these estimating reference tools as a way to go into the future, to keep bidding on the same process, bidding the same way so that you have a systemized process of bidding and you won't make mistakes because you're used to going through the steps and getting there to the right number. There are some automated cost management tools that you can get, inventory analysis, costing analysis for your business. Maybe those would help. Maybe your bookkeeper assembles everything and starts to help you go through so you can make the presentation or of looking at all the jobs and the estimates together after months and months and months. Whatever it is, just make sure that you do it so you can be ending up as a successful contractor. Right now, we're finished with the law and business section. Next thing that you'll get into are the review questions, and I encourage you to go over that. Good luck with the test. Good luck in your business. We'll see you out there.